Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my daily comment for Tuesday, December 15th. Well, tomorrow there will be what must be one of the most highly anticipated FOMC meetings ever. It's widely assumed that they'll raise the key Fed funds rate for the first time since it basically hit zero in December 2008. Now, as New York Fed President Dudley said, this is probably the most well-advertised, discussed, thought about, mused over prospect of beginning a normalization of monetary policy in history. In that case, the question is not what the Fed's going to do on Wednesday. The question is, what will they signal about the future course of interest rates? The committee has to figure out how to set out in the statement their expectations for the future path of rates without committing themselves to a preset course of action. They need to steer a course between the hiking cycle of 1994, when they tightened unpredictably and aggressively and nearly started a recession, and the predetermined hiking of 2004, when they hiked a totally predictable 25 basis points at each meeting, thereby making policy much more certain than it should be in an uncertain world. Now, Chair Yellen suggested that following the first rate hike, any future hikes would depend on the inflation picture, which, of course, she can't know for sure in advance. That means she'll want to leave the committee plenty of discretion to hike or not to, or even to cut rates again if necessary. As she said, there's always uncertainty that pertains to the economic outlook. She said, there are always shocks that occur. In short, the meeting will shift the topic of debate in the markets from will the Fed hike rates to how quickly will the Fed hike rates and how far will they hike them to. The market will be looking for clarification on these points. I expect that they'll continue to emphasize the gradual path of rate hikes and the idea that any future moves depend on the economic data rather than a preset schedule. They're likely to lower their interest rate forecast further in the so-called dot plot that gives each member's forecasts for interest rates. Lower it a bit at least. The risk, as I see it, though, is that the Fed sticks largely to the existing text in the statement and the current dots on the dot plot, which are much more aggressive than the market. That would cause the dollar to strengthen. On the other hand, they may take this opportunity to revamp their statement entirely, in which case the market's reaction is unpredictable. The best model we have to go on may be what happened when the Fed first talked about ending its quantitative easing program. In May of 2013, Fed Chair Bernanke first mentioned the possibility of tapering off the quantitative easing, and the dollar strengthened considerably in what was then called the taper tantrum. There was also a smaller reaction immediately after they started to taper in October of that year, but the response quickly petered out and the currency was little changed afterwards. I think this move, too, may be so well advertised that there might not be much reaction to it, depending, of course, on how they phrase the statement. But the risk, to my mind, is that they accidentally telegraph a more hawkish outlook than the market expects, and the dollar gains as a result. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.